Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much. Hello everyone, and welcome to this channel. It's a great privilege to have once again our good friend Keith Weiner, who's CEO of Monetary Metals, and somebody that really can shed a little bit of light on the current environment, both of inflation and what's happening in gold. How are you, Keith?
Doing well, thank you, and thanks for having me again.
It's a tremendous pleasure. The last time we spoke, we discussed the outlook for inflation. One of the things that I found was quite interesting is that you saw an environment in which there was a risk of going from inflationary pressures to deflationary pressures. Now we obviously have the Ukraine crisis and all of the commodity complex going up. What is your latest outlook on inflation?
So when I speak of inflationary pressures, I'm trying to differentiate between the monetary forces versus non-monetary forces. And even before Ukraine, I was talking about four non-monetary forces for rising prices, and the monetary system being a force for falling prices or downward pressure on prices. So since forever, we've had increasing regulatory burdens, which I call useless ingredients. So they force the petrol companies to put ethanol and other chemicals in the gasoline, which is not understood or appreciated by consumers, not valued by consumers, and very often the consumers aren't even aware of it, but it adds a very real cost to the price of gasoline. And you see that in every industry, whether it's bread, making cars, how many doodads and emission sensors and little extra tabs of metal in the doors, and how many airbags now, 17 airbags and so on. People don't really appreciate the cost of all that stuff adds up quite a lot. So I call that useless ingredients. And whenever there's an increase in useless ingredients, which is pretty much always, then you have a perpetual upward pressure on prices. Number two, I talk a lot about green energy restrictions. And boy, are we seeing that coming, those chickens are coming home to roost, particularly in Europe right now due to Ukraine. But even before Ukraine, I was writing about in the UK, for example, they passed two stupid laws. One, forcing all heavy industry that used to use coal and oil to use natural gas. And number two, prohibiting domestic production of natural gas.
Yeah.
So you all have to use it, and now we can't make it domestically. Then you get a synergistic effect. You get a nonlinear boost of that. So that obviously increases costs there. But you get a nonlinear boost because of a synergy with a third non-monetary force for useless ingredients, which is the whiplash that occurred post the COVID lockdown, which has tied up and snarled logistics and shipping. So the UK having to import all of its natural gas by ship, and now suddenly you get to a point where you can't import Christmas tree ornaments from China to Los Angeles, let alone natural gas. And then finally, economic nationalism or trade war, which isn't just tariffs, and certainly not just tariffs that the US imposes on China. The US imposes lumber tariffs on Canada. It imposes tariffs on whiskey from Scotland, all manner of things. And not just tariffs, as I said, but a general pressure on major corporations to change their supply chains.
Yeah.
That if you were manufacturing in, say, Taiwan, and you're in the semiconductor business, you can see the writing on the wall that perhaps that's not a good jurisdiction. Either maybe okay for now, but you can see that in the future it might not be okay. And so enormous capital investments are being made both by America's #1 domestic semiconductor company, which is of course Intel, and Taiwan's semiconductor company, TSMC, are both investing something on the order of $50 billion building new fabrication facilities onshore in the US. And so all of this onshoring, reshoring, supply chain changes are causing, shortages. It's well known that you can't make cars without certain chips, and there's a shortage of those chips. And the cost of all that investment and all those fabs, has to be borne. Finally, now you get to there's an actual hot war in Ukraine. Without getting into the causes of that or what I think of the participants, the obvious outcome is that one of the combatants is the second or third biggest oil exporter. And suddenly the West is saying, we're not going to take your oil. So the price of oil skyrocketing, the oil market going into backwardation, which is when spot is more expensive than future delivery months. And at the same time, Russia obliged to sell their oil at a bigger and bigger discount in order to find buyers that are willing to take it. So you're getting rising prices, but you're also getting changes to spreads. And Ukraine, one of the other combatant, is one of the biggest exporters of wheat and grain. And suddenly, there's a high likelihood that Ukraine won't be exporting any wheat this year. Yeah. And so obviously that caused a shortage of wheat. The marginal consumer of grain is not going to get wheat this year unless other countries can pick up the slack. I don't know enough about the grain market to know if that's the case. But taking a look at the oil thing, this is one of those things where I'm not sure there's a net reduction in oil production, but there's a disruption in where it all goes. So I'm sure that China is happy to buy Russian oil at a discount. And now what has to happen is all the Russian infrastructure that was set up to deliver oil to the West is now suddenly having to, turn around and deliver it, to the east to China. And so I'm sure they pressed a lot of ships into service for doing that. So what's going to happen is China is going to buy that oil because it's discounted relative to other oil. So China gets a break on price, although most of that may be absorbed by the cost of shipping. Russia certainly paid less. And then meanwhile, whoever China used to buy from is now suddenly not selling to China anymore. And so then they're going to start selling to whoever Russia used to be selling to. And so you just get a complete rejiggering. Instead of oil going by more straight lines, it's now going to crisscross and be more expensive to transport and take longer in the transportation phase. And with higher transportation costs and higher spreads, higher financing costs for that. But the net result is the oil is still moving around, the oil is still being produced, the oil is still being consumed, but you get this disruption. So a lot of people say inflation is any increase in prices, regardless of cause. And I say, well, you have to separate the monetary from the non-monetary. And then the non-monetary forces are pushing prices up. But the monetary forces, which is a falling interest rate, which is a very long-term trend, still is a downward force on prices.
Mm-hmm. And how do you see the outlook in this second part? In the monetary side, we saw a massive increase in money supply in 2021. We saw obviously a still extremely accommodative rate policy from central banks with negative real and nominal rates in many of the developed economies. And now, obviously, we're starting to see a very significant reduction in the growth of money supply, even though it's still above the levels at which it was prior to COVID-19. And we see that central banks are hiking rates despite the Ukraine war. What do you think is going to happen? Do you think that central banks will comply with the target of rate hikes that has been announced? And do you think that we're going to see a significant contraction in money supply growth?
So in 2015, that was the last time that there was just a pervasive discussion of inflation. And of course, the Fed promising to hike rates. Bernanke started to talk of hiking rates, and then inbound Fed Chair Janet Yellen was more serious, claimed to be more serious about it, and said that was what she was going to do. So in 2015, they began to hike. And my prediction at the time was, if they want to go down this path, they won't get very far in terms of how much they can push the rate up, and they won't be able to hold it for very long.
Gotcha.
I felt like I was pretty alone in making. There were a few other lone voices in the wilderness saying that, but it was a pretty lonely position, and that turned out to be correct. Today, the dilemma that they're in is even more severe than it was in 2015. So I'm giving a talk later this week at the Mises Institute in Auburn, Alabama, on a thesis that I call the heat death of the economic universe, that basically marginal productivity of debt has been declining since at least the end of World War II, that's the longest data series that I've been able to get. And so it's probably been declining longer than that. We just don't have the data for it. And so what this is to measure. So people say, well, can we grow our way out of the debt, if not reducing the debt in absolute terms, at least shrink it as a proportion of GDP? And this is one of those things that I'm just like, well, why don't we measure change in debt, change in GDP divided by change in debt, which is marginal productivity of debt. And that's not a very popular metric, because I think it doesn't show a very pleasant picture. And what it shows is it takes more and more debt to juice up the same dollar of GDP, or for a dollar of debt, we get less and less GDP out of it. And so what this means is that the monetary authorities have to be more and more accommodative. So it's not sufficient to simply say they're being accommodative today, but you have to measure that not against, let's say, pre-COVID, because we don't have the pre-COVID economy anymore. We did so much damage with the lockdown. We now have a weakened, even weaker economy than we had before. You have to measure it against that falling trend line and say, are we accommodative against that falling trend line or not? The problem is each act of accommodation actually weakens the economy.
Yeah.
And it goes like this. So suppose you're the marginal hamburger restaurant chain, and you're always building a spreadsheet analyzing, does it make sense to borrow another, I don't know what it costs to open a hamburger store, let's say $1 million. Does it make sense to borrow another $1 million and open up another store? And the biggest factor to that is the interest rate, the cost of the credit. So your spreadsheet is sitting there with a red bottom line, and then they lower the interest rate, and suddenly red turns to green, and you say, now I have a business case. So you, and of course all your competitors, now borrow more to add more capacity to the hamburger market, but not just the production of hamburgers, but also the manufacturers of hamburger grilling equipment, the manufacturers of meat grinding equipment, the manufacturers of refrigerated trucks, the ranchers. Everybody sees that downtick in the interest rate, borrows to increase capacity, and that's why a falling interest rate is a downward pressure on prices, but it's also a downward pressure on margins. So you and all your competitors are borrowing to expand production of hamburgers, unless the average diet of the average person in Spain where you are, or the average American here, unless the diet is changing to want to increase their consumption of hamburgers as a response to the falling interest rate, which is probably not the case, then what happens is you just have a greater capacity, a lower capacity utilization, and falling margins. So with every downtick in the interest rate, everybody's margins falls, whether, so you might have said, okay, I'm going to be smart. I recognize what's going on. I'm not going to borrow to do this, but all your competitors do it. They'll push down your margins anyway.
Yeah.
Everybody has compressing margins, and that lower margins reduces their bid on the interest rate. When can you borrow? Only on a downtick. And so, yeah, we've had a bit of an uptick now, although it's interesting to me just how tepid this uptick is. And this talk of crazy inflation is 8% per annum. Everyone believes that number is a lie. It's actually much higher than that. And the interest rate is where? It's basically just about where it was before COVID.
Yeah.
It's a few basis points higher than that, not a lot. And that was essentially the low in the interest rate. It had been falling for a long time. So we're now back to sort of the pre-COVID low.
Yeah.
As where we are with all this talk of rising interest rates and everything else. So what can the Fed accomplish? They can invert the yield curve.
Yeah.
They can push the short end up, not the long end. And of course, that means that the banks are now losing money. And if you want to improve the economy, making the banks all lose money is probably not the best way to go about doing that.
Certainly. I think that one of the interesting things out of what you just said is how massive the process of zombification has been in the economy. Is that
Yes.
very low interest rates, huge liquidity. They, on the one hand, as you very well said, make the current established manufacturers increase capacity, and higher levels of capacity mean obviously disinflationary pressures. But on top of that, it makes the inefficient survive. And
Yes.
The zombification of the economy is a very, very significant problem also from the standpoint of what happens in terms of credit creation, is that it absorbs new credit that should maybe go to businesses that had higher real economic returns, and ends up being absorbed by companies that are simply don't have a future, that they simply are just zombies out there. And that is obviously very disinflationary as well. But it's a very good point what you mentioned, this problem of the lower bang for your buck that debt entails. Is that what we're seeing is that out of every crisis, economies become more indebted, that in order to generate 1 unit of GDP, it needs more units of debt, and that the only response from central banks is to maintain negative real rates and increase liquidity. So basically it becomes almost a self-fulfilling prophecy, which is a weakening economy that is even weaker because of policy, but because the problem is so widespread, central banks cannot do anything about it. No, so you're in the camp basically that the Fed will not raise rates 7 times as so many people expect, and that even if it did, it's still negative real rates. No.
Well, let me add 2 things to that. One, you bring up the zombies, which is a fascinating phenomenon. Just fascinating that there's even a term for it.
Yeah.
So, you know, a zombie is a company whose profit is less than their interest expense. And the only way to pay interest is obviously out of profits. So if we're approaching, I think, 20% of the major corporations are zombies, something like that. It's not a small number. That's at today's rates with a Fed fund rate, you know, at historic lows. Now imagine if you hike rates, you're hiking the interest expense. That means that even greater percentage of companies who are not currently zombies will be dragged into zombiehood.
Absolutely. That's a very
to your comment about you know, the central banks being forced to be more accommodative. I have been working on my theory of interest and prices. And for purposes here, I'll just say that there's a positive feedback loop, there's a resonance and a ratchet effect, that when you have a falling interest rate trend, and the reason why it's been going on for 40 years is there's a ratchet and a positive feedback. And I've been working on this theory, just turning these things over in my mind over and over. And been thinking of various analogies like falling into a black hole. And when you get past the event horizon, then escape is impossible.
Yeah.
Because the escape velocity is greater than the speed of light, which obviously you can't do. I've been thinking of other analogies, actually, this one came to me. I was at the Cato Institute Monetary Conference, which they have every year in November. And one speaker, I don't know if this was 2014 maybe, or this was 2014, because this was before all this discussion, or maybe 2013, all this discussion of hiking rates. And, you know, all the speakers were basically reading out of the same playbook, which is the Taylor rule of John Taylor from Stanford University. And in fact, John Taylor was one of the speakers himself. But they also had a number of second tier, I think it was Plosser there, Evans, they had several actual Fed governors there. And what they all were basically saying is, gee, I don't know why Chairman Bernanke hasn't raised interest rates, but he really should have raised interest rates, you know, 3 months ago, according to the Taylor rule, 25 basis points or whatever it was. And that's when it finally clicked for me that he's not raising interest rates because he can't. He realizes that, you know, if you grow up, I grew up in upstate New York, which is very snowy in the winter. And something that I think every young boy has to do is there's a certain kind of snow when it's a little bit warmer, and so the snow is a little wet and a little sticky, and you start to make the snowball. And then if you live in a hilly area, which I did, you start to push the snowball downhill.
Yeah.
And you're not really thinking about, you know, consequences or, you know, things like that. Just, you know, it seems like a good idea. I've seen it in cartoons, you know, Bugs Bunny did that or whatever. And you're pushing it down, and the snowball is now picking up all the snow, becoming much bigger, exponentially bigger, as it turns out. And of course, the hill is usually getting a little steeper as you get off the crown of the hill and as you're going down. And what happens is there is a moment, we'll call it, and I'll use a profanity, but I think it's the best possible term for this. There is the oh shit moment when you realize that, you know, you can still have your hands, you know, maybe sort of guiding it or steering it just a little bit, and you can still run and keep up with it for a while. But there's a moment when you realize there is no way I could stop this if I wanted to. Now the fate of this snowball is determined entirely by, number one, gravity, and number two, whatever window or car or pedestrian will be in its path to stop it at the bottom.
Yeah.
And anyway, so that was kind of my analogy for the interest rate, is that they've set up the system and they've manipulated it, and they, of course, central banks want lower interest rates because it enables the government to borrow more and spend more than otherwise could with its tax revenues. And they get to a point where the interest rate is falling and it's out of control. And the people in the absolute inner circle, Bernanke and whatever trusted advisors, realized it, I think. And the people in the slightly more outer circle weren't clued in on that, because obviously that would be very politically explosive for Bernanke to admit it's out of control. He wouldn't want that, you know, a congressional inquiry into that. You know, that analogy to that snowball, and there are a bunch of kids playing with it without any grasp of the consequences. Now, of course, if you're a 7-year-old boy, I guess that's normal. Is you know, you may you know, break a window now and then, and that's the process of learning. These are supposedly adults, and they're not playing with a snowball that's going to break a window. They're playing with the interest rate, which is breaking an economy. Something very different.
Oh, certainly it is. I think it's a great analogy as well, because I think that the problem is that what seemed to be a sort of containable problem a few years ago has become so large that it's impossible. Even if you make these optimistic assumptions of fiscal multipliers that the people around the Fed and the people around government make, it is virtually impossible to get out of this vicious cycle. And you mentioned something that I think is also extremely important, is that if zombie companies were a problem in 2018, if you hike rates at the pace that has been announced, the percentage of zombie companies is going to be much larger. And to me, there's a key element as well, is that most of the zombie companies today are fundamentally very large corporations that sort of can move around. But once you start hiking rates, and many of the smaller businesses have entered into this incorrect dynamic that you were mentioning before, is that you have small businesses in the zombie segment, which become very important insolvencies that generate a crisis. No, so that is the risk ahead, don't you think? Yeah, that we go from an environment in which most of the people are concerned about stagflationary risks, but ultimately the risk is that we see a crisis generated by all of these forces that you mentioned, the non-monetary, the monetary ones, and the fiscal ones.
Yeah, absolutely. You start hiking rates, and then what's going to happen is the zombies are not going to be able to refinance. So first of all, there will be enormous destruction of supply,
Yeah.
So if one's sole focus was consumer prices, destroying all that supply, probably not what you want to do if you want lower consumer prices or at least stable prices. But then beyond that are the bankruptcies, and then sufficient bankruptcies from the debtors will impair and ultimately drown the creditors, who themselves are debtors to somebody else. And then you get a falling of dominoes, a cascading of defaults as it wipes out one balance sheet after another. And it ripples through the system, which is what started to occur in 2008. One reason why I don't think they're going to allow this to happen, in 2008, I think they were surprised. I don't think they understood. If you read what they were saying, even as late as late spring or early summer of 2008, I don't think they realized what they were dealing with. And so they allowed, obviously, Bear Stearns, they allowed Lehman Brothers. And then by the time things were really going, they were really in a panic. This time around, I think they're, I'll use the term hyper proactive.
Yeah.
They have an octopus worth of fingers, and every time any button, lever, knob, wheel needs touching, pushing, spinning, sliding, they have an arm that's all over it, and they have a screen full of indicators. And obviously the Fed is talking to all the major banks anyway, and probably most of the minor ones. And I don't think they're going to allow it, which means they're going to back off their, whether you call it promised or threatened, it depends on your perspective, but they've said they're going to hike rates. And, there's a lot of people in the economy right now that believe there's going to be 7 hikes or 9 hikes or something like that. There's no way.
Yeah.
They're going to have to back off, and then they're going to have some new kind of monetary stimulus to try to retroactively, cure or at least band-aid over the damage that is going to be done. If they hike even once or twice, they'll start to do damage, and then they're going to have to back away from that.
And now they have the perfect excuse. In 2018, they U-turned because of geopolitical concerns due to a trade war that was nothing compared to what we're seeing right now. Now they have the perfect excuse. I would like to touch upon something that I think is quite interesting, is that we have seen something in this Ukraine crisis that in my opinion can radically change the way in which we perceive the financial world, central banks, and the entire financial system, is that we have seen for the first time a sanction that blocks the access of a central bank to its own reserves and access to of the banks of Russia to the SWIFT mechanism. What do you think this is going to generate? Because a lot of people out there, a lot of governors of central banks must be truly worried about the idea that their reserves are actually not available to them in a significant crisis.
I personally kind of think this is a nothing burger. I think it would have been understood that if you invade a country in the West and America doesn't think that you should do that there would be all kinds of sanctions, including locking people out of SWIFT. And I think Russia knew that, which is why their reserves of US dollars and US Treasury bonds were diminishing for years as they led up to this. Obviously, Putin knew what he was planning long before he actually pressed the button. But I will continue with my position that I don't think there's any other paper currency or basket of paper currencies or SDRs or Bancors that could possibly replace the US dollar in terms of the capacity to absorb a flow, in terms of the transparency of the system, in terms of liquidity, in terms of network effect. I don't think there's any other paper currency that comes remotely close. I do think that gold will be the winner in the end, but not in the way that a lot of people in the gold community think it will be, which is some government retroactively declaring their irredeemable currency to be gold backed somehow.
Yeah.
So, in the gold standard, the way currency is created is by an environment of the rule of law, and people trust the banks, and they bring their gold to the bank and deposit it either for an interest-bearing account or a currency unit of some sort. And then if they don't like the interest rate or don't like the risk, they can pull it back. So there's a constant arbitrage back and forth. It's kind of like a bone in your body. Everyone thinks of a bone as a static thing, but actually there are two processes that are in equilibrium. One is the body is always resorbing the bone, and the other is the bone cells are always putting out new bone.
You bet.
And the net, between the two is balance until you get older, and then you start to lose bone density, which is osteoporosis.
Yeah.
So you have today all the irredeemable currencies. Every unit of every dollar, ruble, euro, et cetera, began life as an irredeemable credit. If you were suddenly say, well, these are now gold redeemable, it becomes a price fixing scheme. Like all other central bank price fixing schemes, it will necessarily fail.
Yeah.
So what is going to have to happen is somebody is going to begin the borrowing and lending of gold, and that's really the basis, the foundation of the gold standard. Obviously, that's what Monetary Metals does, so you could say I'm biased. But I think that it's going to be an organic, bottom-up entrepreneurial process of this occurring, rather than any kind of top-down government, declaring it. Aside from which, the gold standard is the monetary system of a free market. Show me a government today that's trending in the direction of free markets. They wouldn't want it anyway.
Absolutely. The other way around. In this environment, the only thing that we're hearing, and actually there was a bill recently passed in the United States about it, is the national security urgency to issue a central bank digital currency. So it's rather the opposite. It's not going into a system in which the paper currency, the fiat currency, is going to be relatively backed by gold. If anything, we have learned from this Ukraine war is that the Russian ruble, which was touted to be the most gold-backed currency in the world, it wasn't gold-backed at all. No, so I think that what you're saying is absolutely true. Is that it cannot happen from a top-down decision coming from governments. It'll have to be bottom-up because there's no other option. And within that framework, what's your view? I'm curious. What's your view about cryptocurrencies here? Because cryptocurrencies have proven to be a very, very bad inflation hedge, and certainly a very bad market downturn hedge in this turmoil. What are your thoughts there? Do you think that is a glitch, or do you think that is a proof of the volatility?
Yeah, I mean, cryptocurrency is extremely volatile. And of course, the volatility is perceived to be a feature by people that are trading crypto to make what even the crypto people realize is what they think is real money. So, smart, nimble traders can make money in both directions. Yeah. But so crypto becomes just a bet to make more dollars or more euros.
You bet.
And it's really good at that. It's much better than gold at skyrocketing and also crashing.
Yeah.
That precludes its use as a serious money. It cannot be borrowed. Nobody in their right mind would take out a liability denominated in Bitcoin when they're promised that Bitcoin is going to go up, 1,000 times from here. Imagine borrowing 500,000 euro to buy a house with the promise that your mortgage will be 500 million euro in 5 years.
Yeah.
Nobody's going to do that, which means all things that are produced in the real world that the Bitcoiners expect to buy with their Bitcoin have to be financed in dollars and euros, not in Bitcoin. And that means that all the vendors need dollars and euros, getting back to why the interest rate's falling. Every producer is in debt up to their eyeballs. And if you're a producer and you're in debt, then your behavior is forced. You must produce more and more and more goods, which you're selling at lower and lower and lower margins to raise the cash. Now, gross margin or gross revenue does not pay debt.
Yeah.
It's net revenue or gross profit,
Gotcha.
or net profit, excuse me, that pays your debt. So they have to set their prices in dollars and euros because they have to service their debt. And any merchant that accepts Bitcoin does so through a third-party API like BitPay that basically taps into the Bitcoin market. So if I show up and I want to buy a flat screen TV for some fraction of the Bitcoin, this third-party API finds a fourth party with dollars who wants to buy Bitcoin and brokers a multi-way swap. The dollars go to the vendor, the TV goes to me, the Bitcoin mostly goes to the buyer of the Bitcoin, and the third-party API takes a fee as they're, for performing the service. Bitcoin isn't really being used as a medium of exchange.
Yeah.
We created the illusion of that with an API. But I think more fundamentally than that, Bitcoin has it's a negative sum game because the cost of running it is so high.
Gotcha.
And so in doing a lot of reading about this, I came across somebody who argued Bitcoin is not a Ponzi scheme, it's a pyramid scheme. And the difference being that in a Ponzi scheme, there's a single balance sheet that is promising a rate of return. And the only way they're generating the illusion of the return is old investors who want to redeem out are getting paid from the new investors that are coming in. A pyramid scheme, there's no central party that's promising anything. You're just simply giving your capital away to person X in the hopes that later person Y, completely different person, will give you even more of his capital. And so that's what Bitcoin is doing. It's this transfer scheme. Everybody's buying in is giving up their money, giving up their capital, and then the smart ones are selling out. And then when they sell out, they get somebody else's money, and then they've locked in their profit. But it's a negative sum game that necessarily, in the end, has to fail. But to quote our old friend John Maynard Keynes, the market can stay irrational longer than you can stay solvent. I would not go and short Bitcoin based on this analysis.
Certainly, and the most important thing as well, in any case, is that, as Hayek mentioned in the choice in currency, is that ultimately all of these independent currencies, the vast majority of them will disappear. There might be one, maybe two that have some level of use as money, but currently they're just startup currencies. They're not reserve of value, certainly not means of payment of generalized use or units of measure. No, Keith, we've run out of time. It's 45 minutes, which is a tremendous conversation with lots of things to think about. As always, I would like to thank you again for your time. It's been a tremendous pleasure, and I look forward to speak with you again relatively soon. So thanks for your time. Thank you very much.
Thank you. Take care.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.